Hey everyone, welcome back to the channel. This week we're doing another fantastic video and we're back on the topic of options. So this week we're going to talk about LEAPS options and their long-term equity anticipation securities. The way these are used is they're used in conjunction with longer-term investments, and they're an alternative for actually owning stock outright in order to leverage our positions in 100 or more shares. So I hope you enjoyed this one, learn a little bit, and can earn some more profits this way. Hello everyone, welcome back to the channel. This week we're taking a look at LEAPS options and how we can use them in order to profit more from our positions. So as investors, we're often looking for different ways in order to make money smarter, work smarter, but not work harder for it in the first place. For this video, long-term and equity anticipation securities, or LEAPS, options serve to deliver exactly that. Their main benefits include the smaller amount of capital that's required to be tied up relative to buying the equivalent in stock units that we would need to do if we owned the entire position. Another benefit is their leveraged nature, and this is due to them being options. And this allows the extraction of higher profitability per dollar invested. Let's take a look now at exactly how they work. As complicated as they sound, LEAPS are actually very straightforward once they're properly understood and the mechanics are understood as well. Any equity or equity index that one wishes to own 100 shares of, or multiples of 100 if you wanted to own more, should be considered to buy a LEAPS call option instead of that. A LEAPS option is simply a call or a put option with our underlying equity of choice, which one wants to own for investment purposes. And this is the key. We want to be able to invest over the long term. And that has an expiration that is in excess of 1 year into the future or more. In fact, they can be as far out as 3 years or up to 39 months to be exact. So we have the choice of how long exactly we want them to be. The key to a LEAPS call option is to buy it deep in the money, or ITM, in order to maximize profits over this longer term horizon. The further out of the maturity is, the more time we actually give the underlying equity to appreciate in value. So essentially then, it's the same as owning 100 shares of the underlying stock or equity index, except for the fact that losses are capped at the option's strike price that we choose and limited to the initial investment amount, or the option premium. By contrast, a stock can theoretically go to zero and wipe out your outright value of the 100 shares. And this is going to be a lot more than your option premium. The profits per dollar invested are leveraged since we don't contribute the full cost to own 100 shares of the underlying, but earn profits as if we do own those 100 shares. Additionally, the option can also be sold at any time during its lifetime, and this gives it great flexibility. This is a great perk since this means we can close our position whenever a modest profit is realized or after earnings or any hard swing to the upside. It's worth noting, however, that liquidity may become an issue when we get closer to maturity. And therefore, it's pertinent to be able to afford 100 shares of the underlying stock at the time of expiration. Now, what this means is that we should actually have 100 times the exercise price of the option at expiration if we do not or cannot sell the option prior to this. When 100 shares are purchased by default at maturity, we have done what's called exercising the option. The best strike prices to purchase a LEAPS option is where delta of the option is 0.8, or about 80% of the current stock price. Historically, this has been the best way to leverage the amount of capital we put up and profit-wise, dollar for dollar. So to quickly find this, just multiply the stock price by 0.8 and buy the option closest to that strike price. So now that we know the ideal strike price to buy at and why we should use LEAPS options, we need to understand how intrinsic and extrinsic value play a role in this. So let's talk about understanding exactly what intrinsic and extrinsic value are. So in order to determine the break-even price of our option in question, we need to know how to calculate both the intrinsic and extrinsic value components of each option contract. In order to do this, we can use the prices of an option we might want to purchase on a specific stock or index of our choice. So for this example, we're going to take a look at Ford, ticker F on the New York Stock Exchange, and look at various call options 1 year out expiring January 19th, 2024. And we can see that in this screenshot here. Here we can see the current price, which is $12.58. We see the cost of the option and the 10, which is times 0.8 of the price, and that we're looking at calls on the 19th of January. So in the screenshot, Ford is trading at $12.58. So 80% of that is approximately $10, and therefore the optimal strike price at which to buy a LEAPS call option is $10. Now it's worth noting that the call will cost $3.44 per share, or $344 total. So now in order to actually determine the intrinsic value from this total cost for the option, all we need to do is subtract the option's exercise price from the current market price. So what this would be is as follows. So we subtract the market price by 10, and we get $258, and we multiply this by 100 for the number of shares to give $258 as the intrinsic value. So since $258 of the $344 is strictly intrinsic value, the remainder is as follows: 344 minus the 258, which gives us $86, and that is the extrinsic value portion of the option price. So this includes sensitivity of the option price to implied volatility of the market, or vega, the option's time decay, or theta, and market interest rate sensitivities, or rho. See our videos on these if you haven't already. Time decay, or theta, is much lower on a longer term option, such as LEAPS, than a shorter dated option. What this means is that there is much less daily extrinsic value lost using LEAPS, and favors us in terms of profitability. Now let's talk about LEAPS calls and puts. So by far, the most common form of LEAPS options are call options. What they allow us to do is they leverage returns on an equity we already wanted to own and simultaneously limits our downside risk. Maximum losses are capped, as mentioned before, at the paid premium of the option. So in our Ford example, for example, our maximum loss was $344 versus $1,258 if the stock was owned outright and went to zero. Not to mention the total costs of the option, which would be $12.58 times 100 shares, or that $1,258. On the flip side, one can also purchase a LEAPS put option, but why would we want to do this? The main reason is to hedge downside risk for holding the actual stock. Puts, as we know, become profitable when the underlying asset declines below its strike price. If we own 100 shares already, we may want to protect ourselves from large losses if the stock declines. The put LEAPS option, purchased 20% above the current market price, will start to earn a return below its strike and offset losses from the stock position. Now, the beauty of this is that if the stock rises, the maximum losses are capped again at the premium that was paid, and further doesn't interrupt profits above this point from the stock position in those scenarios. So now, inevitably, we need to talk about the risks and the benefits of using LEAPS. As with any investment, LEAPS have both benefits and risks. The benefits are relatively self-explanatory from what we have discussed so far. The ability to put up less capital to leverage our investment long term. The idea that we have capped downside losses, and the flexibility to sell our option whenever and wherever we desire, and typically the case if the underlying experiences significant upwards price movement, in which case we would likely want to sell the option and open a new one. The risks, however, are pretty specific and require pretty careful consideration. For example, liquidity might become an issue when we get close to expiration. And the reason for this is that the options are typically deep in or out of the money options at that point, and they experience less open interest at that time. What this means is that we may need funds to cover the purchase of 100 shares of the underlying stock if it is exercised. And we may need to own 100 shares in order to sell them if we have a put LEAPS option. Other risks associated with this relate to the option Greeks, as we mentioned before. Although longer dated options are less sensitive to swings in the underlying stock price, other Greeks can still have a significant effect over the 1 or more year term of a LEAPS option. For example, changes in the interest rate, or rho, time decay, from theta, or implied volatility, or vega, can all vary greatly over a 1-year period through changes in interest rates by the Fed, time decay which can also be altered, and volatility of that stock or market. And this also affects the option's extrinsic value and therefore its price as well. So overall, LEAPS are a fantastic way to leverage capital for a longer term investment. They allow a time horizon of up to 39 months with just one option, and it can be sold within any time period between when it is opened and when it matures for a profit. LEAPS options are great for investors that are looking to have the versatility of these options and the smaller capital outlay it requires, and desire to follow a specific trend in a stock or in the market overall. There are risks to explore, however, and it's therefore in your own power to do your own due diligence and understand these risks before purchasing a LEAPS option. Thanks so much for watching, and I'll see you guys next time.